Right now, while you're watching this, your bank account is being quietly emptied. Not from some catastrophe, not from one bad decision, just a slow, invisible bleed. $15 here, $25 there. The kind of losses that never feel like losses until you sit down at the end of the month and wonder where it all went. Here's the part that stings. Most of these expenses felt completely reasonable 5 years ago. They made sense, they were convenient, they were even clever. But it's 2026 now, and the math has silently turned against you. The prices climbed, the value didn't follow, and nobody warned you. So today we're going to do something most Americans never bother to do. A real, honest value audit. 5 things that are quietly bleeding U.S. households dry. Things that used to be defensible and simply aren't anymore. But before we get to the list, you need to understand the environment you're operating in right now, because the ground has genuinely shifted. The Federal Reserve is holding its benchmark rate at 4.25%. That number touches everything you owe. Every credit card balance, every car loan, every line of credit, all of it is more expensive than it was 3 years ago. Meanwhile, property taxes across the country have surged. The average American homeowner now pays over $3,000 a year in property taxes, and in states like New Jersey, Illinois, and Connecticut, that figure is multiples higher. Add healthcare premiums quietly ticking up, grocery prices stubbornly elevated, and insurance, home, auto, health, rising at rates that outpace almost every wage gain you've seen. And here's the subtle one most people completely miss: bracket creep. You got a raise, it felt good. But federal tax brackets haven't kept pace with real inflation for many earners. You're taking home a bigger number on paper while your actual purchasing power quietly shrinks. You feel squeezed and you can't quite put your finger on why. That's the backdrop. Now let's find the leaks. Number 1, the subscription stack. Here's the trap. No single subscription feels expensive. That's the whole design. Spotify Premium just ticked up to $11.99 a month. Netflix's standard plan sits at $15.49. Hulu, Max, Peacock, Apple TV Plus, YouTube Premium, Amazon Prime, Disney Plus. Each one feels like a rounding error on its own. But stack 4 or 5 of them together, and you're quietly spending $60, $70, sometimes $90 a month on content. Over $1,000 a year. For streaming services you rotate between watching and forgetting exist. Here's the move. Stop treating subscriptions like utilities you can't touch. Start rotating. Pick one. Watch everything on your list. Cancel before the next billing cycle. Move to the next. You're not cutting entertainment out of your life. You're just refusing to fund 11 months of access you're not using. The services will always be there. Your money doesn't come back. Number 2, buy now, pay later for everyday spending. Buy now, pay later was originally pitched as a smart way to split a big purchase. A mattress, a laptop, a sofa. Spread it out, no interest. Sounds reasonable, but look at where it's gone. Over 100 million Americans have now used BNPL services, and a growing slice of those users aren't splitting electronics. They're financing groceries, toiletries, gas, bills. The ordinary running costs of a household being pushed into installment plans. The danger isn't just the debt. It's what behavioral economists call payment decoupling. When a $120 Target run turns into 4 payments of $30 spread over 6 weeks, your brain genuinely stops registering the full cost. The mental ledger gets corrupted. You feel like you're spending less. You are not spending less. You are just fragmenting the damage until 3 separate afterpay installments all hit your checking account on the same Tuesday, and suddenly the math becomes brutally visible. If you are financing things that get consumed before you finish paying for them, food, fuel, household supplies, that is a financial emergency wearing a very calm, user-friendly interface. Number 3, new car financing. For years, the strategy was simple. Walk into a dealership, find a payment you could live with, drive home happy. The monthly number was the whole conversation. But 7 and 8% APR has completely broken that playbook. Dealer-arranged financing in 2026 routinely runs from 7% on the low end to 14% or higher for anything below excellent credit. The payment looks manageable. The total cost of credit when you actually run the numbers over a 60 or 72-month term tells a completely different story. On a $35,000 vehicle, you can easily hand back $8,000 to $12,000 in interest alone by the time you're done. And on a PCP-style balloon loan, you may not even own the car outright at the end. The smarter play is the one most people skip because it's less glamorous. A 3-year-old certified pre-owned version of that same model. The original buyer already absorbed the brutal first-year depreciation hit for you. Sometimes 20% of the vehicle's value gone in 12 months. You buy in after the free fall. You finance at a credit union or online lender, often 2 to 3 full percentage points below dealer rates, or you pay cash. Same vehicle, fraction of the financial damage. Number 4, delivery app fees. The convenience economy sold you a dream, a restaurant-quality meal at your door in under 40 minutes. And for a while, it felt like the future. But the economics of that dream have slowly turned predatory. Here's what actually happens to a $16 burger on DoorDash or Uber Eats. First, the menu price on the app is frequently marked up above what the restaurant charges in person, sometimes by 15 to 25%. Then you get the delivery fee, then the service fee, then the platform's own surcharge. That $16 burger becomes a $30 expense before you've looked up from your phone. And you do this, honestly, how many times a week? Twice a week at that run rate, and you're spending an extra $1,500 a year in pure fees and markups. Not on the food itself, on the infrastructure wrapped around it. Order in once a week as a deliberate treat, and it's a reasonable luxury. Order in 4 times a week as a default, and you have quietly funded someone else's Q4 earnings call with your grocery budget. Number 5. The Ghost Gym Membership. This one is practically an American institution at this point. Estimates suggest Americans waste somewhere north of $1.8 billion annually on gym memberships that go almost entirely unused. The average gym membership runs around $50 a month nationally. Premium urban gyms in cities like New York, Chicago, or LA push $80, $90, even $100 or more for the flagship locations. And the pattern is universal. January hits, you sign up. You go 4, 5, maybe 6 times. Life happens. The visits drop to twice a month. Then once. Then the membership just quietly exists as a recurring charge you've stopped noticing because canceling it means admitting something you'd rather not admit about your fitness goals. Gyms engineer this. The cancellation process is designed with friction. Certified letters, 30-day notice windows, in-person requirements for what should be a 2-click process. It's built to make inertia the path of least resistance. If you have not walked through those doors in 60 days, be honest with yourself. That is not a gym membership. That is a $50 a month guilt subscription. Now here's the bigger point, and this is the part that actually matters. Every single one of these on its own looks trivial. A $12 streaming charge, a delivery fee, a direct debit. But together, they are draining something economists almost never talk about: your financial bandwidth, your margin, your room to move. Think about your income the way you think about attention. When dozens of small, low-value payments are constantly siphoning out of your account on autopilot, you never have anything left over to make the moves that actually change your life. Building a real emergency fund, paying down high-interest credit card debt, maxing out your Roth IRA, saving a house down payment in a housing market that isn't getting any more forgiving. Getting to a position where a single unexpected bill doesn't derail the whole month. The small leaks don't just cost you dollars, they cost you options. They keep you running in place fast enough that you feel busy, productive even, while the finish line stays exactly as far away as it was last year. Here's the mental shift that ties all 5 of these together. Stop thinking of yourself as a consumer, a passive target for every frictionless payment plan, every auto-renewing trial, every $9.99 that barely registers. Start thinking of yourself as a deliberate guardian of your own capital. Someone who knows where every dollar is going and has actively decided it belongs there. Someone whose default response to just $15 a month is a quiet, confident no. Because here's what decades of personal finance research in this country consistently show. Wealth in America is almost never built purely on what you earn. The IRS takes its cut. Inflation takes its share. Lifestyle inflation takes the rest. Real wealth is built in the gap, the margin between what comes in and what you let quietly drain out. That gap, that space you carve out and protect, is where financial security actually gets built. Not all at once, quietly, compounding, year after year. Every subscription you rotate instead of auto-renewing, every essential you refuse to finance on installment, every ghost membership you finally cancel this week. You're not being frugal, you're not depriving yourself, you're widening the gap. And the gap, tended carefully over time, is where every real financial win in this country gets made. So this week, find one leak, just one, and close it. If this gave you something useful, hit subscribe.